So good afternoon. Thanks for joining us today for what I believe will be a very worthwhile panel on the nexus of cryptocurrencies and financial inclusion. As moderator, I'd like to start by setting your expectations for this session. As you know, the title of the session is The New Thing, Cryptocurrency, Blockchain, and Decentralized Finance. And that may seem like both a very broad topic and perhaps somewhat of a mysterious topic. Let me take a moment to say a few things that it will not be. First off, we will not answer the question, should you invest in Bitcoin, Ethereum, or Dogecoin? We are not going to address whether or not coins are likely to become a mainstream payments instrument. And we're not going to go into whether or not cryptocurrency is being used internationally for malicious or illegal purposes. Rather, our panelists will discuss the opportunities and some of the things that must be addressed first for these technologies to contribute to financial inclusion. Broadly speaking, you may realize that the market cap of in-circulation Bitcoin recently crested above $1 trillion, which is twice the valuation of the largest bank in the United States. And even the value of the Ether on the Ethereum network is now greater than the value of all but 3 banks in the entire world. And at the center of all this excitement is the blockchain, whose virtues include its ability to be audited, to be immutable, and to be governed by consensus. In any context inside financial services, where it will be valuable to eliminate redundancy, to give stakeholders access to trusted and verified information, and where real-time updates have value, blockchain can perform admirably. This could include things like identity verification, loan servicing, audit trails, accounting. Our speakers, who include an academic, a regulator, and the founder of a startup, will make comments on how they think the information could be conveyed to regulators and policymakers to help make efforts to support financial inclusion. So today you'll hear from 3 speakers. Adam Levinson is the Anne Fleming Research Professor and Professor of Law at Georgetown University's Law Center. He previously served as special counsel to the Congressional Oversight Panel on the CFPB's Consumer Advisory Board. Donna Murphy is the Deputy Comptroller for Compliance Risk at the OCC. She oversees the development of policy and examination procedures for consumer protections, fair lending, the Community Reinvestment Act, the Bank Secrecy Act, and anti-money laundering issues. And she previously served as director of the OCC's Community and Consumer Law Division, and in the U.S. Justice Department Civil Rights Division as deputy chief in the Housing and Civil Enforcement Special Litigation and Voting sections. Amit Sharma is the founder and CEO of FinClusive, a hybrid fin-reg-tech company dedicated to financial inclusion by providing a full-stack financial crimes compliance platform with digital access to accounts and multi-form payments. Prior to FinClusive, Amit worked in both the public and the private sector, including with Empowerment Capital, Mitsubishi UFJ Securities, and at the Treasury Department, first at the inception of the Office of Terrorism and Financial Intelligence, and later as Chief of Staff to Deputy Secretary and Advisor to the Treasury's senior team under Secretary Henry Paulson. So with that, we'll kick it off to Adam.
So hello, everyone. I'm going to start today with just laying a little groundwork. There is a lot of technical details involved with cryptocurrencies, and we're not going to do a deep dive into the technical workings of any particular cryptocurrency. But what I do want to do is make sure that we're all on the same page about a little basic terminology regarding cryptocurrencies and also about anti-money laundering law, because that's one of the places where there's a potential friction, but also a potential solution coming out of the crypto world. So I'm going to share my screen right now. And if you bear with me, you will see some slides here. Okay, so our starting point is this, something that you're all intimately familiar with and probably don't think very much about because it's so familiar, which is money and the kind of money we regularly use, and that's called fiat currency. It's government issued currency, it's legal tender, meaning you can use it to satisfy debts generically. You can pay taxes in it. You can pay judgments, so forth. Fiat currency exists in a physical form, that's cash, but most of it is actually in a digital form already, deposit accounts. Right? There's not money sitting in a vault backing your bank account. It's really large because of fractional reserve banking. There's actually very little cash or cash equivalents sitting around at a depository institution. Now, when you're making payments in fiat currency, if it's not with cash, those payments all go through institutional intermediaries. You write a check, and there are banks involved in taking, you write a check on your account at one bank, it's deposited at the payee's bank, and maybe there's a clearinghouse or some other bank in between. That an intermediary might be the Federal Reserve, it might be a private entity. So we track ownership of fiat currency in centralized ledgers. Right? These are just databases to figure out who owns what. And the central bank's ledger tracks what banks themselves own. So the Fed knows what banks have accounts at the Fed, and the Fed knows how much every particular bank has on deposit with the Fed. And then those banks' own ledgers track what you and I own. So this is all very familiar. But you need to understand this to understand what cryptocurrency changes. And we might just kind of, if this is easier to understand graphically, if you look at this, this image, you see that we have a bunch of consumers on there who are kind of the end users. Each of them had banks, and the banks all interact through a central node. And that central node is where you have the ledger kept. And then if we kind of go and look at one of these banks itself up close, right, it's got a whole bunch of consumers at the bank, and the bank has a ledger of what all the consumers owe. Okay, now let's compare that with cryptocurrencies. A cryptocurrency only exists in a digital form. There's no cash. There's no physical coin of a Bitcoin. And it's a currency that is secured by cryptography. And often these cryptocurrencies, typically they don't have to, but they typically operate using a type of a database that's called a distributed ledger. A distributed ledger is a database system in which all the participants in the network have what should be an identical copy of the database. There's no one central database. Instead, it's distributed. And when you're putting new entries into the database, new ledger entries, that has to be coordinated and verified. And there's a software protocol that will do that. So, and if you want to look at this graphically, right now, you see that there's no longer any kind of central counterparty in the system. It's just a lot of banks dealing bilaterally with each other. Where we go? Here we go. And what this means is you can get, with a cryptocurrency, you can have a system that allows for direct peer-to-peer payments without running them through a financial institution. If you want to convert that cryptocurrency back into US dollars or euros, you're going to need someone to change that for you, and that would be some kind of a financial institution. But within the system itself, it can all be peer-to-peer. You don't need a financial institution. And here you can see it just, if we take out the banks, we could just have the individuals, and they all have a copy of the ledger themselves. Now, a particular type of distributed ledger is called a blockchain. And a blockchain is just a database. It's a database that consists of an ever-growing chain of chunks of data. Those chunks of data are called blocks, and they're chained together chronologically. So this lets you see what was done first, what was done second, so forth. The creation of new blocks, so adding data to the blockchain, requires solving some sort of a mathematical puzzle. That's the crypto part. There's something is encoded, we're going to solve the code. And every time a new block is created, it gets added to everyone's copy of the ledger using the software protocol. So this is blockchain. It's only a particular type of distributed ledger. It's not the only type. It is a generic technology. Blockchain can be used for lots of different things, right? It's just a database. So we can use it to track who owns a currency, but we could also use it to track things like consumer identity documentation. And once you put a consumer in a system, then it can be used not just by the central party that has that ledger, but it's distributed. It can be used by lots of parties. Now, lots of cryptocurrencies run on blockchain technology, most famously Bitcoin. But it's important to understand that blockchain is not the same as Bitcoin. Right? You can have there's plenty you can do with blockchain that has nothing to do with Bitcoin. Okay, last slide I want to show you is a little about anti-money laundering regulation. So the basic problem here is that if you are a criminal, you might be doing this to make money. And the problem is that federal law provides for civil and criminal asset forfeiture. Proceeds of crimes are subject to forfeiture. So if you want to keep that those ill-gotten gains, you need to somehow launder or conceal the origin of the assets. You need to make them look clean. We have a substantial federal regulatory regime for anti-money laundering, or AML, and counterterrorism financing, CTF. And that's meant to prevent the financial system from being used for laundering illicit funds. The main federal statute in this, and you may hear us referring to this acronym, is the BSA, the Bank Secrecy Act. It's really not so much about bank secrecy as about what banks have to do to report on things. It's the Bank Non-Secrecy Act. And the Bank Secrecy Act has a requirement that, that financial institutions have both a customer identification program, where they verify the identity of their customers, and a customer due diligence program, where the financial institution understands the nature of the customer's business. And that's for the purpose of developing a risk profile of understanding if something looks strange about what the customer is doing. The shorthand for this, it's not a formal regulatory term, but the shorthand for customer identification programs and due diligence is Know Your Customer, or KYC. And with that, I'm going to hand it back to Adam.
Thanks, Adam. I think that was really great. I think we really needed kind of a level setting understanding and the glossary of what we're talking about. You know, one of the things I really want to capture from what Adam said is the extent to which the blockchain is almost like an infrastructure that many people can use to do many different things. That there's this decentralized finance, right, which is part of it, but there are also many other ways that a person could use the blockchain. But, and this is really where I think Donna's going to really jump in, there are really a lot of open questions with how we merge legacy regulatory approaches with the challenges presented by this technology. So take it over, Donna.
Thank you so much. Can you hear me? Okay, great. Well, first of all, I want to thank you, Adam, and the whole NCRC team for inviting me to be part of this really interesting and timely topic and discussion. As you mentioned when you introduced me, I have sort of a unique perspective on this as a regulator, because my team at the OCC has responsibility for policies and procedures, both relating to anti-money laundering and to other areas that are very relevant to financial inclusion, including fair lending and community reinvestment. So picking up where Professor Levitin left off, I'm going to talk a bit about the BSA AML, as we call them, requirements and the impact on banks' provision of services to customers, how the OCC as a regulator and supervisor is approaching these issues, and then suggest a couple of ideas for ways that the new technology underlying cryptocurrency, blockchain, distributed ledger, could potentially help to expand access and financial inclusion. So starting with the BSA, I think it's important to remember that the BSA was enacted and the current regulations and guidance were written to require banks to prevent or detect and report suspicious activity to protect the financial system. The system was designed to cast a pretty wide net because it's hard to determine who is a bad actor, and based on the incomplete information that's usually available to bankers. Recognizing this challenge, over the last several years, the OCC and other federal regulators have worked together to try and clarify for the banking industry how the BSA requirements should be applied using a risk-based approach, Adam mentioned the customer risk profile. That's really the approach that regulators take to and that banks should be taking to this. But determining the risk of a particular customer using your customer due diligence process requires a lot of information. So we've issued a couple of statements to try and that I think help to set the groundwork for the kind of discussion we're having today. We issued a joint statement with other regulators encouraging banks to consider and, where appropriate, implement innovative approaches to their BSA requirements. We also issued a number of statements clarifying the risk-based approach to customer due diligence, including one that's specifically focused on charities. So with that underlying framework, what we're looking at as a challenge is how to identify the bad actors, those who might be engaged in financial crime, as distinguished from all of the other majority of consumers and customers out there who are not. And the strong customer due diligence processes that are required for that can require a lot of information, as I mentioned, and that can drive up cost. So banks that have to have these additional customer due diligence processes in order to distinguish among customers can result in higher costs, and that can lead to determinations that a particular product or service can't be provided because of the cost of compliance. And that, in fact, many of the reviews and surveys that have been done in recent years on a phenomenon known as de-risking actually have highlighted cost as one of the main factors that leads banks to stop providing services to certain categories of customers when they do that. So that brings us to where we are now, which is in looking at these new technologies, how can they help to provide, to fulfill these requirements that bankers have to comply with the Bank Secrecy Act, which of course is probably not really aptly named, but comply with their anti-money laundering and counter-terrorist financing requirements cost effectively. Can they get information more effectively, more complete information, quicker, easier, and more effectively in order to really understand the customers and the transactions so that they can comply? And this is one of the hopefully promises or potential for these new technologies, is to really provide that information, provide new services and ways of delivering services that can do that, and allow banks to provide at a reasonable cost services to a greater group of consumers, to a greater span of consumers, increasing financial inclusion and access. And so I think I'm going to stop there, and then so we can get into the discussion sooner.
Super, thanks, Donna. And I think what I really want to capture from what she said is how the rules that are in place already to prevent bad actors are certainly just as justified now, and perhaps even more so. And really, I think transitioning to what Amit's going to talk about, there are some real questions of how do we get from where we are now, where we have uncertainty and banks hire lawyers to address uncertainty frequently by deploying the answer no, and then leaving people outside of the financial marketplace, right? Small businesses and consumers. How do we get to where the abilities of these technologies to produce auditable, verifiable systems create confidence? And so with that, I think you'll really be fascinated by what Amit has to say and with what his company is working on right now in this space.
Well, thanks very much, Adam, and mirroring Donna's comments. I'm just going to throw my slides up here. Hopefully you can see them now. Great. So thanks very much. Yes, by way of the background, as Adam had originally explained, I spent a good amount of time as a policymaker in the U.S. Treasury Department, working very closely with the interagency, the OCC, the Federal Reserve, all of our regulatory bodies to see where and how we can strengthen anti-money laundering, counter-terrorist financing, and what we would call broader financial crimes compliance goals. Because the intent is really sound, which is how do you protect consumers from exploitation by bad guys? How do you keep bad guys out of the financial system? And how do you ensure fair, equal, equitable access to everyone who needs it? But there's some systemic challenges in this broader and changing marketplace that is both exciting, but also reinforces the need for that very same compliance. So I've put some of those up here. One, on the top is the trend toward a more decentralized or the globalization of our financial system cross-border, with increasingly non-traditional financial services providers providing products and services directly to the market. Whereas 20, 30, 40 years ago, majority of the financial services and products, you would have to walk into a regulated bank financial institution. Increasingly over time, you can get most financial services and products outside of a regulated bank. And while that poses tremendous opportunities from an inclusion perspective, obviously we have to also ensure and be mindful of the very same intents of financial system protections, consumer protections, and the like. And so now technology applications are coming to bear, as Adam had indicated earlier, that can link individuals directly without a central intermediary, that can put individuals and companies wherever located on the globe to interact with each other financially without that central intermediary. And the question then becomes, while that is a boon for inclusion, how do we ensure the same intended protections are in place from a bank secrecy, from an anti-money laundering, counter-terrorist financing perspective? But a second trend is happening here that we've seen, and that has been because of the growth and exacerbated by the growth of financial crimes compliance to the broader financial services industry, including those traditional institutions and increasingly these alternative non-bank, non-traditional financial services institutions. Donna touched on it a little bit with this concept of de-risking. Understandably, many banks look at either certain customer segments, certain jurisdictions, certain types of activity, certain client types as naturally higher risk. And to be honest, having put the government hat on and now in the private sector hat, the government hasn't been a particular help over time on that, because we've identified certain sectors, jurisdictions, etc., as higher risk. And so if you're a financial intermediary regulated by official authorities that come and audit you for what you're doing and your understanding of risk, it's a natural consequence for some of them to say, ooh, the costs for compliance and engaging these certain segments just outweigh the benefits of that engagement. Unfortunately, that has fallen incredibly disproportionately on the global poor, low moderate income, immigrants, nonprofits, international correspondent banks, and increasingly these alternative financial services ecosystems like those in the virtual asset or cryptocurrency space. These fintech companies, these alternative non-bank financial services that, if they're new, they're considered a little bit higher risk. How do you ensure that engagement? And at the end of the day, regulatory compliance is paramount to have those protections in place, but they really also need the exact same mode of innovation and modernization that we're seeing in the financial services landscape. So this increased globalization, this increased peer-to-peer engagement, this increased decentralization, this increased unbundling of products and services requires that we also have regulatory frameworks that can comport to, quite frankly, what is really operationally speaking, technologically speaking, financial services that just don't look, feel, or act like financial services in the 1960s, 70s, and 80s, right? And so we have to comport that. We have to look at financial services regulation with the same level of modernization and innovation as we can. Now, it goes to say, because we're talking about inclusion, the plight of the excluded is massive. And sometimes we underestimate this because we tend to look at the unbanked or the underbanked, those that don't have access to formal bank accounts or that do not use them as a primary mode of financial services engagement. It actually is hugely underestimated when you then start looking at the number of companies, small businesses, entrepreneurs, nonprofits, non-individuals that are equally underserved or excluded by the financial services marketplace. And at the end of the day, if, for example, you look at, and this was exacerbated in the pandemic time period over the last year and a half, where small businesses being impacted in the emerging and frontier markets where the predominant job accretive activity is small business growth, if the vast majority can't access working capital to get going, that's a problem. And that has large systemic and societal implications as it does individual implications. So financial inclusion is truly a matter of national and economic security. And the more access we can provide begets that engagement, begets the ability for individuals and organizations to grow financial resilience and actually grow financial health, which is our ultimate goal. Now, where can some of these technologies come to bear? And taking off of the presentations from just previously from both Donna and Adam, in the characteristics or the attributes that Adam in particular had discussed, we are applying some of these technologies in a couple key areas. On the anti-money laundering and know your customer side, right? Ultimately, if you look at the vast majority of the BSA, the USA Patriot Act, global standard from the Financial Action Task Force, which is the global standard setter for AML, et cetera, all of the anti-money laundering, financial crimes compliance really comes down to one question. Do you know your customer? Do you know the nature of their services? What are their expenses and income attributes? What's the volatility look like? How do you service them? Not just for compliance and risk management, but really the same information is equally valuable when you think about the products and services you want to put in place for those. And as Donna was pointing out, there's a lot of inconsistencies, inefficiencies, redundancies, and therefore that all translates to costs for compliance. And the average global bulge bracket bank is spending upwards of 30% of their entire operating budget for governance, risk, and compliance. And so it's natural for them to do that cost benefit. So what we do at Inclusive, among other things, is leveraging these tools to bring down a lot of the redundancy and inefficiencies associated, and in two key areas related to AML KYC and with respect to the movement of funds. We leverage the blockchain and the immutability of the ledger to effectively create a bit of a KYC utility or know your customer utility. So if the organizations in a particular network are originating clients, running them through appropriate KYC, know your customer protocols, customer due diligence, where you're doing your address checks and your sanctions checks and your global watch list checks and your identity verification, we can actually put those attributes on a blockchain, and we can leverage them by still protecting the underlying PII or personal identifying information of those individuals, but share the results when third-party institutions need to do that verification as well, thereby taking away a lot of the redundancy of third-party institutions doing the very same checks, but also inside the same institution, many of those checks have to happen over and over and over again. And so by doing this, one can actually leverage the underlying information, present results of those checks to verify and validate that Donna is who she says she is, that Adam is who he says he is, to multiple third parties without having to go through those redundant and costly checks and the like. Similarly, we also leverage blockchain by facilitating cross-border payments. And there's both peer-to-peer payments as well as network or permission blockchain payments in which we're involved. And what that enables is there are a number of organizations globally that can build on these open source protocols or these open source software protocols that allow them to create an ability to connect to a number of other organizations globally outside of the traditional interbank systems like SWIFT or ACH, and thereby being able to transmit value via data securely through that chain. And one can do so in a very quick and expedient manner, including between two nodes directly, like a peer-to-peer payment, taking away a lot of the intermediaries that cross-border payments or correspondent banking that has to go through multiple intermediaries, but also creating those transactions in a way that, like Adam was talking about earlier, is all on an immutable, traceable ledger. And that allows us to do transaction monitoring and audit, equally important from a risk and governance compliance perspective, but that is valuable business intelligence as it relates to the economic footprint associated with these organizations and individuals that lend value to each of these organizations, saying, how can I provide better products and services to you? Compliance traditionally has been seen and has been operated under this sort of veil of being a fixed cost, growing cost center, the bank of a bank. But it actually is sitting on a tremendous amount of information that is really applicable to better service customers and clients. And so the blockchain tools that underlie some of the services that were earlier described, whether it's cryptocurrencies, whether it's payments, whether it's information, can be used because of its decentralized nature, because of its immutability, because of its traceability, to do the things that traditionally have been human-centric, a lot of hours, or redundant, and ways to create a network effect and almost a utility effect in that regard. The net result is we, to use the charity example, we have a crowdfunding platform that had tremendous challenges engaging payment services or banking. And as a nonprofit that was categorized by the US government and others, thus the guidance that Donna had talked about earlier, nonprofits were looked at by a number of institutions as considered a higher risk for money laundering and terrorist financing. So this organization had a hard time finding banking services. And secondly, they did a number of services that were very plain vanilla low risk, a la organizations raising money for scholarships for underprivileged youth. But some other campaigns were raising money for refugee assistance for Syrians crossing the border into Turkey, where you have to understand the ultimate agent providing those services and ensure there's no exploitation involved. And so they engage our platform to not only do the last mile due diligence, but it creates a profile of all of the players in that chain to ensure that that due diligence is shareable when needed to verify and validate once that organization was going to now receive monies for that particular humanitarian campaign or nonprofit or charitable works. And in that regard, we create an immutable ledger that can be analyzed. We create linkages directly with the organizations delivering that service and being able to then link them into US banking and making it much more seamless to do that cross-border payment with a much cheaper facilitation because you're not going through multiple intermediaries. So this is one example of many that we can leverage to use this underlying technology. I'll send it back to you, Adam.
Great. So I think I want to capture, Amit just covered quite a lot, but I think where it really pulls into financial inclusion in a simple way is when you think about where the rubber hits the road for a bank that's trying to decide yes or no on a consumer. The more uncertainty they have, the more cost they have to figure out whether or not this person's worthy of the risk, right? So if we can reduce that uncertainty, we can reduce those costs. And who is that most important for? Well, it's really most important to the potential customer who's probably not going to be a huge account, right? The customer who's traditionally unbanked has a $1,000 a month account in the United States, for example. The potential revenue from that customer is low. And if the cost of finding the customer and then the cost of qualifying them for KYC, when the information isn't there, it's not a really great return. So a number of banks are going to say, not interested. Same thing to a small business. Let's say in an example along a border, person has a lot of experience in this field, but from another country. How do you get that information in a way that you feel trustworthy, that you know it's valid? The blockchain can be a solution to that by providing access to information that's been verified already, isn't full of many redundancies. So the opportunity is really here for great financial inclusion. The question is how do we get from here to there? So what I was thinking would be great now, since we have a few minutes, would be to kick out an open question to our panelists, which is to think about this question either from the regulatory side or from the market side. On the regulatory side, how do we open up to give banks the room to make good decisions? And can this be a part of that? And then from the market side, does this move the needle enough? Will this be enough to get us to financial inclusion? So I'm going to kick it off with, I'm going to leave it open. Whoever wants to jump in, start.
Oh, so this is Donna, and I'll start with the regulatory side because I think that's, as has been identified, modernizing the regulations and regulatory approach is a key concern here, a key issue. The technology and some of these financial services companies are zooming down the road, and regulators aren't known for our speed. but it's important that we are moving forward to try and keep up with that and to enable these new technologies where it's appropriate. I think Amit made the point very well that mean, not everything is going to be appropriate, right? There's a very good reason why we have anti-money laundering and counter-terrorist financing regulations, and our job as regulators is to find that right balance. I think one of the things about cryptocurrency that is sometimes not recognized immediately by people who aren't as familiar with it is that while cryptocurrency and more directly the technology underlying it can be used to preserve anonymity, which would actually be somewhat counter to what we need in order to comply with anti-money laundering regulations, it can also be used to increase transparency if it's used properly. And I think there's a lot of movement right now by the regulators and maybe even more importantly, there's a new anti-money laundering act. It's really quite extensive revisions to the anti-money laundering regime that was passed by Congress and became law. It's called the Anti-Money Laundering Act of 2020, but as my colleagues like to remind me, it actually became law on January 4th, 2021. But it really does focus in these areas. It focuses on clarifying and solidifying the risk-based approach to these issues. So, not one size fits all. We need to look at the customer risk profile, and it is very, very, I think, leaning in. It's really moving us forward. It's going to move us forward in terms of innovation and technology. It requires new interagency committees to push this forward. And I know committees don't sound fast, but that's how we work, right? It requires the agencies to have BSA innovation officers. There's a whole series of provisions that are going to push us forward on this. And I think that's a good thing because there is, the OCC has done some work in this area. We're one of the agencies that has started to take some steps to say what kind of cryptocurrency related activities are legally permissible for banks. So that's moving, that's a step forward. All these different pieces need to come together so that we can, establish the framework on which these new, hopefully better, faster, more informative, more accurate, and as you said earlier, Adam, immutable and auditable technologies can be put in place so that we can, increase the efficiency and decrease the cost, and therefore provide better access to financial services through traditional providers. I'll hand it back.
Donna, I agree with Donna on that perspective. And because, again, coming from that side of the house, there's a reason for natural skepticism of innovation in the sector because you don't want consumers hurt. You don't want the system to be at risk. The challenge here, as Donna rightly points out, is innovation in the sector will always outpace regulatory innovation, right? There's always going to be a lag where regulators catch up to what's being innovated in the marketplace because innovation is sort of that birthright in capitalist societies, certainly, but commercial environments where you're trying to innovate and bring something new into the marketplace. So one of the areas that really requires a much more cohesive public and private dialogue, and not just in this sort of ethereal theoretical sense, but really in a very practical sense, is that these new technologies are fundamentally changing the operational framework of financial services. Payments in an intermediary-based environment looks much different than peer-to-peer payments in a mobile-to-mobile or digital environment. Today, I can send value from my mobile phone to an individual's mobile phone in Thailand near instantaneously. That's a reality today in which maybe no intermediary is involved at all. Whereas 30 years ago, I'd have to go to a bank, that bank has a correspondent, that correspondent facilitates that payment to another correspondent, then to the home bank of the individual, and then that individual is conferred the funds. But if I take all of those intermediaries away, like Adam had described at the outset, who is the regulator? Who's the oversight? Who does the KYC, right? So these control gates to protect consumers still are relevant. And yet the question becomes, who is responsible and how do we ensure that there's access when investigators, law enforcement, regulators need that access? This is the beauty of some of this new technology, where one can have the ability to protect sensitive information, a la protecting critical privacy issues, and have access to either transactions, the history of transactions, and the ability to then do analytics around those transactions in an open way where you don't have that in a cash-based or intermediary-based financial environment. But that innovation now needs to have regulatory oversight or rules that comport to a completely and fundamentally different operating or technological environment. And today, what we continue to see, unfortunately, although that is changing incrementally, is that we're still taking the kind of legacy architected rules of engagement from a risk governance and compliance perspective, and now applying them to frameworks, technologies that are no longer relevant to that architecture. They're completely in a different architecture. So how do we apply the very intent of know your customer in ways that are now inside a new architecture? And what blockchain has the promise to do is to be able to do a couple things in tandem that service both the ability to engage more individuals and companies into the financial system, but also provide a level of mutability, traceability, auditability to law enforcement and regulators that are required when you're talking about a highly sensitive industry like finance, because personal finance is hugely important, very sensitive, and we need to protect it from both exploitation, but also that consumers can rely on those systems. And the final thing I'll say from an inclusion perspective is that digitization is the new norm, and the pandemic has certainly reinforced that. And so the ability to actually go to your bank by just reaching for your phone is the new reality. And that's across the board: access to healthcare, telehealth, education, financial services, government services. We are increasingly moving to the digital environment, which is a boon for access, because even in some of the most emerging and frontier markets, you still have 90+% smartphone penetration rates, and the growth of digital inclusion continues. How do we couple that growth with the same controls that must exist in a purely digital environment that, quite frankly, legacy architected banks and payment systems never were architected? They were never built that way. So it's coupling those. So it reinforces in some the need for a very, very healthy and kind of in tandem dialogue with regulators saying, here's how this innovation is meeting your need as well as access needs. And secondly, that we need an ability to now reform regulation to comport with the new architecture and operational realities of this new environment. And when we do the two, we can strip away this false ethos that has governed compliance, in my humble opinion, which is exclusionary. It's how do I look at your risk and box it? And with that environment, we have to look at financial crimes compliance, anti-money laundering, also with a view of if we are actually denying services, actually excluding parties, we don't really have an effective regime, do we? We have to have one that is inclusive. That's an effective regime because that drives greater access. Access drives greater financial benefits. Benefits and health leads to greater financial resilience.
So I can't disagree with anything that Donna or Amit just said, but I do want to push back a little on the idea that we are in a totally new architectural paradigm. Certainly the slides I showed you suggested we are. But there's a little more detail that suggests that maybe it's a little different, not quite as stark of a contrast. And also I want to push back a bit on and express some skepticism about the financial inclusion benefits of technology. So when we move from a centralized system to a decentralized system, it does not entirely eliminate financial intermediaries. They exist, they're just performing somewhat different roles. For example, if when Amit is going to send money to someone in Thailand through his phone, he needs software on his phone to do that. Someone's providing that software. We can call them a tech company, but we could also, if they're providing software that moves money, we can call them a financial institution, right? And once we call something a financial institution, then it's actually kind of easy to fit within our legacy AML framework. You're a financial institution, you have some responsibilities. Similarly, when Amit wants to send money to Thailand, he has to get money into that system. If he's using a cryptocurrency system, he has to start at some point, he may have cryptocurrency already around, but at some point in the process, he's got to go from moving fiat currency into a cryptocurrency system. And to the extent that merchants are not willing to take cryptocurrency for various transactions, or governments are not willing to take it as payment for taxes, it has to be possible to convert the cryptocurrency out of the system. Once you have that conversion node, that's another financial institution, right? And those are nodes where you can have AML, you take the traditional AML framework and apply them. It's a different set of institutions, and they may not even really think of themselves as financial institutions. And I think there can be a bit of a cultural issue there, right? You think of bankers as being a bunch of guys in suits and ties, and tech companies are guys who are probably 30 years younger and wearing flip-flops and jeans that cost more than the banker's suits. But it's not a culture that's necessarily used to compliance. But I think there are certainly institutions there for which the AML framework can be applied. But it's going to have to apply in a somewhat different way. Okay, now on financial inclusion. Undoubtedly, technology can lower the costs of verifying who a customer is, and as Adam explained, if you lower that cost, maybe it's it's easier to bring a person into the financial system. I think the real issue is one of about magnitude. Right? The customer verification costs are not negligible, but the real problem with banking and with banking unbanked consumers is that they are going to maintain very low deposit balances. And banks make money in two ways. They make money on the spread income, right? You get, this is the 363 model, that the bank pays you 3%, it reinvests your money at 6%, and the banker's on the golf course by 3 p.m. That spread income is very small with a small deposit balance. With a $1,000 balance, you're talking about $30 of spread income a year if it's a 3% spread. That's not going to cover the cost of sending out monthly billings and monthly account statements, much less the share of overhead for the account, all the other factors. Reducing the compliance costs for AML, that helps, right? But it may not be enough. And that means that banks, especially for low balance customers, where they're looking to make money is from fees. And there's nothing inherently wrong with charging consumers fees. But once you move into the realm of fee income, that's where you see consumer protection problems. Because when you move into fee income, the competitive pressure is to put fees in a way that they're less salient to consumers. Right? You can see this with credit cards. Annual fees are quite rare now on credit cards because you're going to pay one of those. So what does the smart card company do? It moves the cost from the annual fee over to a contingent fee, like a late fee or before the card act over limit fees. And that those contingent fees are less salient. The consumer can't predict very well whether he or she's going to pay them. But at the end of the day, they may actually be more expensive. And there's also, they may not apply to they're going to be more focused on a subset of consumers. And that's where we start getting consumer protection concerns. So I'm a little worried that, yes, we may be able to bring more people into the system, but we're bringing them into a system that may not be the best system for them. Similarly, to the extent that we have problems with small dollar lending, it's not clear to me that technology is really going to move the needle that much. Because the small dollar lending problems, a lot of them relate to the fact that these are small loans. Lenders are doing a very small number of unique borrowers per lender. And that means that their fixed costs, which are not going, we can change them a little, but their fixed costs have to be amortized over a rather small base of dollars. That unavoidably pushes up fees. And that means you're going to end up with high APRs in any circumstance. Yes, we might be able to go from 300% APR down to 250, and that's all good. But I don't know that we're going from 300 to 36%. And I think we should just be cautious about how much we expect technology to change things. It's going to improve the world. Is it going to transform it? I'm doubtful.
Great. So I feel like we've had a lot of nuance here, a lot of depth. I think right now what we should do is we'll go to Q&A, and I expect that there'll be some good questions there, and our panelists are ready to, I think, expand even further. So saying that, really appreciate you taking the time to step in on our panel, and I want to thank each of our panelists, Donna, Amit, Adam, for their thoughts, which I think are really valuable. Okay, thank you.
Thank you. Thanks for having us.
Well, I'm going to jump in now, and I want to reiterate that this was a good conversation. Looking at the comments, I'm seeing several different categories of questions come in. There was one sort of about who are high-risk individuals. There are another set that relate to sort of, let's call it, by whom and how, which would be what types of financial institutions. Is this exclusively fintechs, or is it also banks? And then what kinds of products would this be relevant to? And then the last one, we had an interesting question about privacy. Is this safe, private, etc.? So I'm going to throw out those three things, and people can jump in, and there may be others. But yeah, let's start there.
Well, I'm happy to jump in, Adam, on at least a couple of the quick questions here, especially as related to higher risk. And I see how that can be a little bit confused based on some of the presentations. When we're talking about higher risk here, we're talking a bit exclusively around what constitute risk from the standpoint of a money laundering, illicit finance, counter-terrorist financing concern perspective. And what banks need to do is take their own sort of risk methodology, their risk appetite, and then look at certain customer segments, look at certain activities, and then assess whether or not they have the wherewithal to address and mitigate those risks. What we were talking about earlier in the presentation time was that certain types of constituencies, certain types of activities, certain jurisdictions are otherwise categorized or labeled as high risk. Sometimes that is from international standard setters like the Financial Action Task Force saying these certain jurisdictions have a weaker money laundering compliance framework, and therefore interactions, transactions, client engagements into and out of those jurisdictions constitute higher risk. In other instances, those groups like the FATF or government regulators have said certain types of clients, like nonprofits, like money service businesses, money transfer operators, remitters, constitute a potentially higher risk for money laundering and terrorist financing. That can be a challenge. On the one hand, there may be data to show certain exploitations of those groups, but it's a challenge for banks then saying, I'm going to be presented by incoming clients that are nonprofits or money services businesses. And if they're being categorized by regulators as higher risk, there's going to be greater scrutiny. Now it's on the banks to then say, to the financial institutions to then say, can I address and mitigate those risks? Then there's the follow-on, which is, I think, aptly described in Professor Leviton's examples, is in and around inclusion. Unfortunately, those segments of the economy, those client types, those activities that have been categorized as higher risk have unfortunately and disproportionately fallen on activities predominantly used by the global poor, like international remittances, are hugely relied upon by remittances from quote unquote wealthier nations to poorer nations, or low moderate income groups that have less access to basic financial services. Importantly, and the pandemic has shown this, small businesses are categorized in that. Small businesses that need to provide 3 years of audited financial statements before a bank potentially provides them, a small business loan. Near impossible for many small businesses. That becomes a risk calculus for institutions. And then finally, I would say some of the tools here, especially in and around distributed ledger technology, blockchain, are applicable in a whole slew of contexts, some of which are just being tested. Some of the areas that they have been put into production have been in the payment space and the compliance space. Another application of blockchain technology is in identity management, which also plays into know your customer, but you can leverage this technology to actually enhance the privacy protections of individuals' underlying information while still being able to send or share underlying information of those individuals or those businesses in ways that remain protected. The whole idea of using an immutable ledger to look at transactions from a transaction monitoring perspective for money laundering purposes can leverage the blockchain technology to do so. So there's a lot of different applications in that context. So I hope I address some of what constitutes higher risk and where some of the disproportionate impacts due to de-risking and money laundering has come, and then some additional applications of where we and others are deploying blockchain technology to enhance those capabilities and bring down costs to provide that better access.
Yeah. So if I can just jump in here for a minute, I think that, sort of taking up where Amit left off, there certainly has been an approach in many cases to anti-money laundering, financial crime risk, of sort of categorizing customers in certain high-risk boxes. And one of the things that we have been doing over the last couple of years as regulators on an interagency basis is to try and make clear that that is not required, and that the individual customers, I mean, the first thing you do have to do is you have to establish your identity in order to, that's required by the laws. It's sort of the baseline. And as Amit said, one of the promises of the underlying technology, the blockchain and the distributed ledger, is that there may be a better, faster, more universal way of establishing identity. We're not there yet, but that's certainly something that a lot of people are working on. But once you do that, regulators have tried to make clear that what the regulations require is an assessment of risk of the particular customer or transaction. And to look back at when most of these laws were passed before the recent legal update here in the U.S., that was a very manual process, and so it was in many cases less expensive to sort of categorize people into boxes of high risk. But now with the technology to distinguish and to quickly and readily be able to compile information on transaction history or the products and services a particular customer has used, or the other types of information that Amit has talked about, that there is the potential for making it more, less costly and more efficient, and allowing for more access in a way that complies with regulations, hopefully being updated, and also provides more access. So there's a lot of factors that go into that kind of calculation, and it is there, as Adam said, there's clearly a consideration. Financial services companies, banks or otherwise, are looking for, are interested in making a profit. They're profit-making institutions. So the more efficiently they can comply with the regulatory requirements in the financial crime area and otherwise, the more chances there are for at least incremental improvement in access.
So I just want to add one small point here, which is that the trade-off between greater inclusion and maybe going lighter on compliance is going to look different to different people within a financial institution. In particular, your compliance officers, they're not going to get rewarded for an expansion of the bank's business. Instead, they do well when there are no problems, and they are going to by nature be risk averse. And that means that they are going to be inclined to decide things as being high risk when there's any doubt. And I don't know that technology is going to solve that problem. Maybe as it gets greater adoption, it starts to, and compliance officers become more comfortable with it. But from a compliance officer's perspective, why take the risk? What's the upside in it for me? And the answer is there really isn't any.
Yeah, and I would just add to that. I think that's a good segue, and it actually is reinforced on a couple of the comments that were reposted, right? Around, do we see financial institutions actually scapegoat or use as an excuse high compliance or compliance reasons to then not serve certain constituencies? Absolutely, we do. And in certain instances, that's full-on discrimination. Let's just say what it is. There are certain groups that have been categorized as higher risk. Sometimes US and other regulators have expressed so, and then have to follow on with guidance, like, for example, the recent guidance on nonprofits, that not all nonprofits pose a terrorist financing or money laundering risk. But the challenge is that broad-based kind of assumption or label put on certain groups. And absolutely, we see financial services discriminate against certain groups, labeling them as higher risk, or saying that there's just the compliance burden is too high. Part of what technology can solve is efficiency. Part of what technology can solve is also taking away redundancy. And part of what technology can solve is also in access, service channels that bring financial services and products to that last mile, especially as digital inclusion continues to grow. But one additional comment here is that, therefore, it then begs the question, who should be obligated to undertake know your customer and anti-money laundering and other activities? And arguably, as financial services continue to expand outside of traditional channels, then one has to look at the activities and operations and practices of those organizations to ultimately determine if they are, quote, covered from an anti-money laundering perspective, meaning do they also have obligations? And we would argue that, especially given the expansion of more non-traditional and alternative financial services providers, more and more organizations, quite frankly, fall under the framework of being therefore obligated to undertake know your customer and other activities, because they are in fact doing the business of what has been traditionally the purview of banks. And so financial services is well beyond just traditional banks and deposit institutions. It is now social media companies, e-commerce platforms, and crowdfunding. With a little bit of software, a lot of these organizations are in fact financial intermediaries. They're storing value, they're issuing value, they're sending value, they're providing lending and credit facilities, and they may not be regulated as as banks. And that is what's got a lot of regulators, taking a look, and rightly has got a lot of providers saying, what are therefore my obligations? And we would argue taking a really activities and practices based approach should determine what those obligations are. So some of this technology is absolutely applicable for both traditional bank FIs, financial institutions, as well as a number of these alternative financial services providers.
Well, so this has been great. I think it's almost time to wrap it up. I was going to ask every one of our panelists if there's one more thing they'd like to add that they think might, add to this conversation. And then we'll wrap it up. And I really want to say thanks to our audience. Lots of great questions. All right.
So I'll go first. I think this has been a great discussion. I think that the point that regulations, that were designed to work 20, 30 years ago, and, not that they were perfect then either, but, need to be updated. We, on the BSA side, we are in the process of, FinCEN, led by FinCEN and the Treasury Department, are in the process of doing that, and need to take into account the fact that, financial service providers are not all or even mostly banks these days, right? They need to be principles based. They need to be technology neutral to the extent they can be, and really focused on the balancing of the need for, anti-money laundering, counter-terrorist financing, and financial inclusion. And those principles are all embodied in the act that Congress passed early this year. So we will be focusing on that and on how we can encourage responsible innovation and hopefully make at least incremental progress in this area.
Sure, and I can just quickly follow on from Donna. My last thoughts are really reinforcing three underlying principles. Just as we are seeing innovation in financial services continue to evolve, we need to see innovation in regulatory compliance. And I think that's where we're starting to see a bit more application of new technologies. But that requires a recognition that financial services, products, the ability to store value securely, the ability to send value, the ability to extend credit and provide financial products is fundamentally changing. And it is happening technologically in ways that does not resemble core or legacy banking. And so regulatory compliance needs to have equally modern approaches. Secondly, it's that some of these new applications, like when using or delivering solutions on a blockchain, have inherent built-in attributes that actually aid compliance, like was presented in the overall presentation of the immutability of the ledger, the ability to decentralize information, to be able to get away from concentration risk of all the information, especially sensitive personal identifying information in one space. those are hugely important attributes to aid compliance and financial system integrity, security, as well as privacy protections, especially as more financial services delivery channels grows. And then the third one is one that is really going back to the overarching. And Professor Levitan made this comment. Ultimately, financial access does not beget financial resilience and financial health. And that's our goal. What we really need to be looking at is not just, can we put more individuals into a quote an insured account? Can we actually raise the economic resilience and overall financial condition and financial health of individuals and businesses, small businesses and entrepreneurs that are the lifeblood of this economy? And if we can do that, that's where these technology applications will have shown some value. And that comeuppance has not happened yet, right? So there's a lot of technology applications out there. Are we seeing more applications that lead to greater inclusion, and that inclusion also allows for greater financial resilience and economic strength? And that's where we need to go with respect to the application of these technologies.
So, there's no question this new technology is here. And one of the real challenges that regulators are going to face over the next decade is going to be figuring out how to domesticate or housebreak it, right? And that's going to mean setting regulatory standards and making institutions that have a certain compliance culture, sort of our legacy institutions, comfortable with the new technology, and bringing the new institutions into a compliance framework. Those are all going to be huge challenges. And there's also no question that there are going to be places where the new technology is going to help with financial access. There are going to be applications where blockchain technology is going to lower costs, and that will, to some degree or another, help on the financial inclusion side. But here's what I worry about. I'm worried that technology is just the newest version of the market will provide argument, that the idea being that the market's going to solve this, it's going to solve our financial inclusion problem, and it's going to solve it with the miracle of new technology. And I'm just not sold there. I'm worried that it becomes that technology is too often a convenient dodge for having to make hard political choices about whether we have, just plain and simple hard mandates of providing basic bank accounts, or whether we want to have a system where we have express subsidies of financial services for low-income individuals. And I think we need to be careful that we don't use technology as a way from avoiding having those more difficult political conversations about financial inclusion and making sure that everyone's able to participate within the financial system in the commercial world.
Well, great. So thank you to all the panelists. The last thing I'll say is really to the audience. We had heard a lot from our members that there was a lot of curiosity about blockchain, cryptocurrency, et cetera, et cetera. I would really be thrilled if you could respond with some feedback over the course of the conference or afterwards. It'd be great to hear if there were things you heard here that you didn't know about, or if there were things that you still are curious about, or things that just affirmed already what you know. All those things would be really valuable for us. So please do that. And so I want to close now. Thank you. And panelists, this has been great.
Thank you.